Welcome back to the Neuro Finance Masterclass. Today, on day 113, we dissect the internal leverage bones of public corporations. My co-host and I are incredibly excited because we're about to dive deep into the absolute lifeblood of the balance sheet today. Right, let's look at our strategic roadmap for this explainer. We're going to cover the corporate leverage bones, define the DE ratio, decode sector benchmarks, expose the interest rate trap, and finally conduct the ultimate leverage audit. Let's get straight into it. Part 1, the corporate leverage bones. So, yesterday on day 112, we engineered those DeFi yield structures, right? Well, today we are firmly back in the traditional stock market. Look, to build a massive enterprise, corporations literally burn through cash. I mean, they need tremendous amounts of capital to build out physical factories, to hire top-tier talent, and really execute aggressive operational expansion. And to fund all of these moves, every single company faces two fundamental choices. Exactly. It boils down to this. Shareholders' equity, which is money raised directly from owners, something we covered back on day 89, versus debt, which is money borrowed from lenders from day 84. You know, amateurs out there, they obsess over top-line revenue and these flashy product launches. But the true architect, they inspect the structural skeleton of this exact capital mix to effectively balance the capital structure. Moving on to part 2. Defining the D/E ratio. So how do we actually inspect that skeleton? We use the debt to equity, or DE ratio. The math here is pretty straightforward. It equals total liabilities divided by shareholders' equity. This right here is the absolute ultimate measure of financial leverage. It calculates exactly how many dollars of debt exist for every single dollar of net assets that the shareholders actually provided. Let's translate this corporate math into a real-world analogy so we can really picture it. Imagine you're buying a $500,000 property. You put down $100,000 of your own cash. That's your equity slice. To cover the rest of the cost, you take out a $400,000 mortgage from the bank. And that, of course, is your debt slice. Now do the math on that. $400,000 in debt divided by $100,000 in equity gives you a personal DE ratio of 4.0. In the corporate world, finding this single number answers the ultimate strategic question. Who truly owns the business model? Is it the partners who founded it? Or is it the banks who funded it? All right, section 3, decoding sector benchmarks. Now, we have to remember our core rule from day 103. Never, ever analyze a ratio in a vacuum. Generally, a DE below 1.0 is the safe zone. That's your independent capital shield. A DE above 2.0 pushes you into high leverage territory. Sure, that can hypercharge growth during central bank liquidity expansions, but man, it becomes a completely lethal weight later on. But notice there's a middle ground here, the capital-heavy sector exception, which ranges from about 1.5 to 3.0. And that exception exists entirely because of the fundamental nature of the business model itself. Capital-heavy industries, think utilities, airlines, or real estate, they naturally command higher DE ratios. Why? Because their physical infrastructure acts as solid, tangible loan collateral. Now contrast that with asset-light tech fortresses. A software company just doesn't have massive, heavy physical machines or buildings to pledge as collateral. This difference is exactly what an architect is hunting for. Those capital-heavy sectors can safely tolerate operating in that 1.5 to 3.0 range, but those asset-light tech fortresses, they must maintain aggressively low DE ratios, ideally sub 0.5. If you see a software company with a DE of 2.5, that is a massive, glowing red flag. They lack the collateral, which means the second a macroeconomic winter hits, their survival is in instant jeopardy. Which brings us to section 4, the interest rate trap. Listen closely because this right here is the absolute most dangerous scenario for over-leveraged companies. It's exactly why an architect religiously checks the DE ratio to avoid leverage-driven bankruptcies. Step 1, macroeconomic seasons shift, central banks hike rates, and we enter a monetary tightening cycle. Step 2, a company sitting there with a bloated DE ratio suddenly has to refinance its short-term debts, and boom, their borrowing costs just skyrocket. Step 3, that massive new debt service load completely vaporizes their EBITDA margins and their net income. Honestly, this is how true architects spot bankruptcies months before they ever happen. I actually want to read a quote directly from the source text here because it just perfectly captures this trap. The operational engine might look healthy on the surface, but the leverage bones shatter from the debt service load. Think about that. You could literally have an elite sales team crushing their quotas, but if your interest payments double overnight,
that underlying skeleton just collapses.
Finally, Section 5, the ultimate leverage audit. Okay, time to turn all this mathematical theory into aggressive, actionable strategy. Here is your direct cognitive task for today. Step 1, select a stock from your personal tracking list. Step 2, pull open their balance sheet. Step 3, find the total liabilities and the shareholder's equity and calculate that DE ratio for yourself. Step 4, compare this exact metric against a direct sector peer. If you do this, you're not just guessing anymore. You're actively auditing internal structures like a master architect. Which brings us to our final, highly strategic question to leave you with today. When you look at your own portfolio, is your capital backed by a bulletproof self-funded fortress? Or are you holding shares in an over-leveraged house of cards that's just waiting for an interest rate shock to blow it over? It's time to stop trusting surface headlines, audit those capital bones, calculate the actual risk, and rule the cycle. We will see you in the next explainer.